The crypto market is tense. What can investors do to protect their money? When opposed to established financial systems, the crypto market has always been seen as a decentralized and autonomous option. Recent events, however, have demonstrated that even digital assets are not immune to geopolitical shifts. A number of crypto behemoths have already decided to accept recently announced sanctions against Russian users, and no one knows what will happen next. Let's look at the major methods investors may safeguard their assets in this jittery market. Tether, USDT, has stated that it will support the penalties. For Russia-based accounts, Circle, USDC, has disabled fiat payments. 25,000 Russian addresses were blacklisted by Coinbase. Russian users have been barred from the MetaMask wallet due to their geolocation. This is just the tip of the iceberg, and the list is only going to get longer. Stablecoins are now a danger. Sex exchanges are dangerous. KYC data is dangerous. How to keep your money safe. We've identified 3 key strategies for users to safeguard their cryptocurrency investments. Use algorithmic stablecoins and Layer 1 solutions. Switch to DEXs. For business purposes, use crypto barter. Let's get into further detail. The following are the primary scenarios that are preventing progress. While the situation on wallets and exchanges is quite straightforward, recent statements by issuers are concerning. After all, MetaMask isn't the only one attempting to restrict users based on their IP address. Consider Tether as an example. The issuer of the USDT never pledged anonymity. The business has already blocked Ethereum addresses at the request of the government. What will happen if geopolitical sanctions are considered? Tether could feature a centralized API for wallets and exchanges, which would mean that transactions are logged in chains after centralized processing. If that's the case, geolocation blocking will just take a few days. Companies may do a collective analysis based on KYC data, IP, transaction volume, and directions to identify holders from the Russian Federation. There's also the possibility that Tether will cancel USDT wallets using the clean dirty money approach. In this situation, tracing techniques like chainalysis will be used to identify Russian holders. They provide federal agencies with data, software, services, and research, as well as powerful investigation and compliance tools to help them solve cybercrime cases. The prohibition will begin with wallets and exchange data. Following a data leak from wallets and exchanges, users will be blocked. The method will not be accurate because identifying holders from the Russian Federation is difficult. If a user wishes to unblock your account, they must give documentation that they are not a Russian citizen, as well as proof of income. Another possibility is that the blocking is ineffective and does not pose a threat. Many wallets do not require KYC, are not restricted to the Russian zone, and the token can be wrapped at any time. Wrapped tokens, like stablecoins, are blockchain-specific assets with the same value as the base coin, such as Bitcoin or Ethereum. Tokens like this make it simple, quick, and easy to transfer assets between chains without having to pay a lot of money in conversion fees and transactions. Tether recognizes that it can only block amateurs in this scenario, making the switch to Layer 1 cryptocurrency. Switch to Layer 1 solutions, like as Bitcoin and Ether, as well as promising assets like Polkadot, which permits transactions across several blockchains. Layer 1 cryptocurrencies are those that just feature a basic blockchain network that requires code updates and tweaks to maintain scalability. Layer 2 solutions, on the other hand, take a different approach. They add an extra layer to the original blockchain in order to boost the number of nodes and, as a result, the system's throughput. Metahash is again Layer 1, a huge benefit, and decentralized, with a transaction speed of 3 seconds. It is the only blockchain that allows for large-scale transactions and fast payouts. However, there is a catch: if the chain breaks up due to node connection failure, transactions are not performed until the chain is automatically reconstructed. Nonetheless, network decentralization and dependability are ensured. Because there is a switch, Tron, for example, is completely centralized. Almost every L1 is worth thinking about. Consider Cosmos, which makes use of the inter-blockchain communication protocol to facilitate free asset transfers between sovereign and decentralized blockchains. Algorand is a permissionless blockchain network that allows anyone to become a validator without requiring a lot of computing power while retaining security, scalability, and decentralization. Diversification is the key, however. It's impossible to predict which networks will be operational in the future. The Layer 1 network's hacker protection and transaction speed are the most crucial elements to consider while selecting a project. The benchmarks indicated above will be highly sought after in a world where trading on CEX markets is impossible. Stablecoins selected using an algorithm. Refrain from using traditional stablecoins, USDT, USDC, etc., and instead consider algorithmic stablecoins. For example, DAI is a valuable stablecoin that is fixed to the US dollar. It lowers volatility risks and provides a variety of DeFi options, including as lending, borrowing, and trading. Frax is another option, acting as a decentralized exchange that employs a variety of techniques such as stablecoin minting and redemption, as well as staking. However, you should exercise caution. Many coins, for example, are Ponzi schemes rather than stablecoins, despite their appearance. When it comes to DEX exchanges, switch to direct local exchanges between wallets and DEX exchanges instead of CEX exchanges. DEXs have several advantages, including the elimination of middlemen and the user's sole ownership and control of their tokens. Here are a few ideas to consider based on your objectives. Uniswap. Automated liquidity mechanism based on a fixed product formula and implemented on the Ethereum blockchain as a system of non-upgradable smart contracts. It does away with the necessity for trusted middlemen, placing a premium on decentralization, censorship resistance, and security. Serum DEX. The permissionless system for decentralized exchanges based on the Solana blockchain, which enables DeFi customers with excellent transaction speeds and cheap transaction costs. Shiba Swap. Users can exchange Ethereum-based tokens such as ETH, DAI, USDC, USDT, AXS, Matic, and hundreds more on this trading site. Staking of 3 Shiba Inu coins, Leash, SHIB, and Bone is also possible on the platform. 1inch. The exchange aggregator that ranks decentralized exchanges and assists consumers in locating the best Bitcoin prices. The site is powered by the 1inch utility and governance token, which allows users to profit from their staking by promoting liquidity. Using cryptocurrency to conduct business. For enterprises, crypto barter with counterparties is a realistic option. Here's what you can do. Assist counterparties in forming legal entities in Hong Kong, Wyoming, or Delaware. Open a crypto wallet and transfer your DAI to it. Use an agreement to contribute to the company's balance sheet. Use crypto wallets instead of bank data to draft a series of service agreements between counterparties. To sum it up, despite the fact that the crypto market is growing increasingly jittery, and there is no way of knowing what the new penalties would entail, there are still effective strategies to safeguard your funds. Switch to Layer 1 cryptocurrencies, avoid traditional stables and CEX exchanges, and consider crypto barter as a viable business alternative.